All right, well, we are seeing some softness for stocks as we kick off the Friday trading session. We've said it before, we'll say it again. Worries about where the economy is headed as central banks continue to focus on higher interest rates to fight inflation seems to be the table stakes right now, especially after we have seen such a big run, particularly for the S&P 500 this year. Let's get some more insight and analysis from Brenda O'Connor Juanez, Senior Vice President, Financial Advisor at UBS. Great to see you as always, and I would love to get your take on the bull-bear debate these days.
Well, here we go, John. We're in the midpoint of the year. And so let's take stock. And the best way to describe it is that everything was more resilient than we expected. And by everything, I mean the economy, particularly that labor market. I mean earnings. I mean equities. Look, the S&P is up 20% from that October low. You know, there is a path from here on in where equities can trade higher, but we have to acknowledge that that path is a narrow one. So much right needs to happen with inflation, with the Fed, et cetera. And so for us, we're still positioning pretty conservatively and meaning a preference for fixed income over stocks. But if you are going to step into equities, the strategy here should be laggards and looking outside of the U.S.
Okay, so a few pieces to slice and dice there, Brenda. So let's start with fixed income. What do you like in that area? And when you transition into it, sort of how are you going about that?
Right. And let me just take a step back and say we like fixed income on a relative basis. You know, you see the equity risk premium over stocks is at a 45 to 50% discount to that 10-year average, which essentially is just telling me that bonds are more attractive than stocks. Look at what the PE is on the S&P. It's almost 19 times. That's a 15 to 20% premium. And so within the fixed income space, we are doing a barbell strategy, getting some exposure at that front end for liquidity and income, and then going further out the curve in some investment grade corporates. Okay,
helpful context there. You mentioned if you are going to look to equities, maybe keep an eye on the laggards. What are the kinds of areas you're watching there?
Yeah. And John, you know, we all know at this point that 90%, 90+% of that S&P rally is the Magnificent Seven, the Surging Seven, whatever kind of term you want to give to that group of tech stocks. Now, the rally is broadening out a little bit. And so we think that gap is going to narrow. So if you're deploying that marginal dollar, here's where I would look. I would look to those high quality laggards, particularly in consumer staples. I would look to industrials and energy. And John, you and I have talked about energy before, and the same dynamics still hold. Free cash flows at 10%. You have, you know, a tight energy market as it is. I know WTI is in the low 70s, but here's the thing. If we expect or if we see a huge stimulus program from China, that's just going to benefit these energy names.
Okay, so watching energy, which has underperformed, playing a little safety. I do want to come back to those, you described them, the Magnificent Seven, exactly, whatever, however we want to describe it. You've got some mighty stocks out there. We had a conversation earlier this hour with a guest who is very skeptical of that group at this stage. Do you pay much attention to the analyst calls? Because I was looking, some of the technology companies have run through these so-called average one-year target prices. But this morning I looked on the Bloomberg terminal. You've got Microsoft, NVIDIA, Alphabet, which is the parent of Google, three of the names that have been very popular AI-related plays this year, where the average 12-month target price is still higher, not a lot higher, but higher than where the stocks are right now. Do you pay much attention to those analyst calls?
I do, but more importantly, for me, it's a valuation call and a relative play call with that marginal dollar. These are great names, and I think that if you're holding them, great, but there's an opportunity here to take some cash off the table, deploy it to other areas that have more of an upside potential. So I think it depends what your starting point is, John.
Okay. Another interesting conversation that's been taking place recently is where does the dollar go, the U.S. dollar, I should say, in an environment like this? Obviously, it had a huge run. Some people had said, okay, we've seen peak dollar. I feel like there's been, you know, a fresh dialogue building on that, depending on where we go. But I know that you're thinking a lot about that and also thinking about it through the lens of what happens to gold. So I'd love to get your take on that, because obviously we've got a lot of gold investors here as well.
Of course. And, here's the thing. If we expect that equities are going to trade flat for the rest of the year, which is our UBS core house view, investors are going to have to find other places to make money. And we think currencies could be an interesting place. And the way we're playing that is with the weakening dollar. So here's our cyclical view. We think that, U.S. growth and that interest rate premium the U.S. dollars had versus the rest of the world is going to erode over the coming months and next year. And so that's going to weaken the U.S. dollar. Now, remember, the U.S. dollar hit that 20-year high last year. So part of this is just what currencies always do, reversion to the mean. But, looking outward in terms of attractiveness of currencies, we prefer the yen, the euro, the Aussie dollar. I would even throw the Canadian dollar in there. You brought up gold. Well, here's the thing with gold. It's up 5.5% this year. But we still think that it has further to run because it will be a beneficiary of that weakening U.S. dollar. So we actually have a price target on gold of 2,200 for around this time or earlier next year.
22.